How long was it before you guys were like, no, we want to do more of this? Like, we really want to get into this asset class?
Right away.
Yeah, right away.
Right away. And then last year is when we decided, hey, we can do better than what our property manager is doing.
But how has your revenue done over the last year and a half with these changes?
Revenue's definitely gone up.
What did that do to the value?
Now that we're increasing the NOI, now it's 2 or 3 times.
That NOI get a pretty good boost?
Oh yeah.
So you guys had corporate jobs, you had managers, now you jumped in and self-managed. You're doing great. You're looking at more deals. What is your plan? Are you wanting to keep self-managing them? Are you wanting to add more? Like, where are you guys going? Thanks guys for being here. So right out of the gate, you guys are closing your 4th facility this year?
Yes, we just did about a month ago.
Oh, you just did?
Yes.
Okay, so it is closed.
It is closed.
Yeah.
And now, where are you guys from?
We live in Arizona, in Prescott, Arizona.
All right.
But I grew up in Georgia, so all our real estate's in Georgia.
Oh, okay. Well, that works. And when did you start? Like, when did you start getting into storage? You already closed your 4th facility this year, so.
Well, we started in real estate investment in 2010.
Okay.
And we made a relationship with a broker who became our property manager, and he started getting interested in storage. He actually attended one of your events.
Nice.
And he got interested in storage, and he introduced us. He said, there's a storage facility for sale. Are you interested? I'm like, well, what's that?
Yeah.
And then, so that's how he wanted to be a property manager for them.
Okay.
And so, yes, we bought it in 2019.
So had you done real estate previously? Like, had you done like single family homes or something like that?
Yeah, we kind of did the gamut. We started with single family homes, then we did a flip,
Okay.
which was hard to do remotely, if you can imagine. And then we got into a small apartment building, and then we didn't like that. That was kind of a pain. And it was like a C- class. And then we came across a storage opportunity, and that was 2019. We bought our first one.
Mm-hmm.
And then we bought 2 more, pretty much one every year after that.
All right.
Expanded one, we kind of doubled the size.
Walk me through this first deal. How big was it? Was it was out of state? So your first one you did really far out of state too.
Mm-hmm.
Yeah. So walk me through the deal. Like how'd that work? What were your thoughts? Were you nervous about it? I mean, it's very different than going to other asset classes, obviously.
So we didn't know anything about the business. It was really, we're just passive investors at the time. And I guess like this manager, he brought it to us. And we were trying to get out of the apartment building. And we were going to 1031. So he had a network of people. Like, there was basically this one guy that was building a lot of storage in that area. This is kind of rural Georgia. This isn't that close to Atlanta. So there's smaller properties, and it's a good old boys network, and he found it. We got a good price, and it was basically matched up with our exchange money, and look, the numbers penciled out pretty good, so we said, let's just do it.
And then you got that one.
Yeah.
And that obviously must have gone better than the multifamily stuff, because you were like, you liked it.
Yeah.
Mm-hmm.
So that went pretty good.
Yeah.
How long was it before you guys were like, no, we want to do more of this? Like, this went well, and we really want to get into this asset class.
Right away.
Yeah.
Right away.
Right away. Yeah. It just was so much smoother, and right away.
You got the first one. How long till the second property?
The next
Less
year.
than a year, yeah.
Yeah.
Okay.
Yeah.
So it was quick. And were you using 1031 exchange money again? Were you selling other properties? Or was it just, nope, we're saving up and then we're going to get the second one?
I think it was a combination of both.
Mm-hmm.
Okay.
Yeah, we had we still had some single family stuff we were selling and exchanging into the next 2 that we bought.
Mm-hmm. And home equity. We're using
Yep.
our personal home equity.
Yep.
Yeah.
Nice.
Yep.
That's perfect opportunity, especially back then when interest rates were so cheap.
Yeah.
It's a great taking that capital, that cheap capital, and putting it into something that was yielding high.
Right.
And now the properties, were they close to each other, or were they in different cities?
Technically in different cities. They're all within a 30-minute drive of each other.
All right. But your manager was the same.
Correct.
So the manager. Now, when they took it over, was there a lot of work that needed to be done?
No. They were basically two were basically had just been completed. So they were one had been operating for maybe a year or two.
Yeah. How'd the fill-ups go on the ones that were just completed?
Super quick.
Super quick.
Like within 6-8 months, they were stabilized.
Yeah, no wonder you liked it, guys. You're like, this is awesome.
I think we were at the right place at the right time.
Right.
It was pretty awesome.
That is awesome.
Yeah.
And how has that gone over the last 3 years? How have the properties done? Because it was 1, 2, 3, right? Like
3,
within 2 years.
And then we doubled the size of one of them.
Yeah.
Okay.
We had land, and so we doubled the number of buildings.
All right. And that one filled up pretty quick then too.
Yeah.
That did.
Man, that's awesome. And then the last 2 years, did the property still do good, even though interest rates went up? How's that been?
So they kind of were just on autopilot. So we were still pretty passive. We were still getting a check every month, so to speak. The loans, again, were back when interest rates were lower, so they were pretty good. We had one adjustable rate loan that's kind of killing us right now, but we have some options there. But yeah, they were just kind of steady, but we weren't really that involved in it. We got our monthly statements and
just consistent.
Yeah. It was definitely a passive income type of an investment.
That's amazing.
And then last year is when we decided, hey, we can do better than what our property manager is doing.
Yeah.
And that's when we got involved with self-storage income to kind of learn the ropes and how to do it ourselves. And we took over management September of last year ourselves. So we kind of pulled the trigger on all 3 properties at once.
Wow.
That was something.
Yeah.
We made some changes. Like he had a gate that just opened in the morning and closed in the evening.
Yep.
So we put in a gate system that tied to the property management system. We changed property management systems. So we made some improvements, added cameras, things like that.
Okay. How's that gone now? It's under your management. How's that worked?
Well, it was rough for a little bit because we didn't know a lot of things that the manager was kind of, it wasn't his job. It's his job to hide all the little nitty gritty things for us. So we now discovered all those. So like the delinquency, he wasn't really kicking people out because he figured as long as you're less than 100% full, why kick anybody out?
Yeah.
So we kind of learned that process and started booting a lot of people. So our vacancy kind of went way up.
Yeah.
Because he was showing us numbers at like 95% vacant. Well, great.
Great.
A lot of those people weren't paying.
But they're not paying.
So it was delinquent. Some people died, we know. Some people are in jail, and now all of a sudden.
Yeah.
So a lot of that, was a learning process. She really is the operations expert and stuff.
Yeah.
But, we're both from like an engineering and process background. So a lot of it is fun, let's say. We love getting the system.
I agree. I'm like, how can we make this go move and do better and solving the problems? It's one of the things I actually love about storage because there is change in those rotations. It's not like a long-term lease that's 10 years and you have 2 tenants and it's just over. Like you can optimize. So now you guys took it over. You're getting rid of delinquencies and you learned what a lot of people learn, especially in storage, that physical occupancy and economic occupancy are very different. And so that you obviously have to get rid of a lot of people. And on one side, it's like, oh man, we're seeing our occupancy go down. But how has your revenue done over the last year and a half with these changes?
Revenue's definitely gone up, even though our vacancy has gone up. Mainly because now all the fees and extras, like we probably had kind of not the greatest deal with our manager. Like he kept he didn't really institute a good insurance, tenant protection program.
Yep.
And he kept all that income. He gave us a very small cut of like the fees.
Yeah.
And so now we are getting all of that and we get a lot of late fees because people for some reason don't pay out. So now all that's really added to the bottom line. And we also started raising our sell rates.
Yeah.
We haven't worked on the in-place income yet. That's something we're kind of our next step, but we definitely started raising rates to the market.
It's amazing too how you can take it and go from more of a passive, especially when the manager is treating it more like a passive, the change you can make because your revenue is up, but your occupancy is down. To me, I'm like, that's gold. That's exactly what you want, because your revenue's up, your properties are now all worth more. You're in a little, and net income is huge in value, as you know, because of the cap rate. So all of a sudden your wealth is going up, but then you actually have something to sell.
Yeah.
So now you can actually go to market and you can get new tenants in, and like you said, at market rates. So now every time you're putting someone in, it's at that higher rate, and from someone that wasn't paying. So the spread, that's really big. That changes that revenue per square foot, right? So do you think it's been worth it?
Oh, yeah.
Yeah?
Oh, yeah. If you had asked me in October, when I was answering all the phone calls.
Yep.
And we had a call center, which has been great. Like, that's really made customers happy to have that call center. The manager only answered the phone. He had a VA that only answered the phone for a few hours a day.
Yeah.
And our call center is much extended hours. So that's made customers happier.
Increased security.
Increased security.
Increased service.
Increased service. Yeah, and we respond to people, and people really like that. They're like, oh, you're responding to us. And so, because we run it like a business, because it is a business.
It is a business.
And it's, and so then customers appreciate that.
You heard me obviously say this, but our original model, I stick to it, where I'm like, answer the phone, let people know we're there, and make them pay their bills. And it's amazing how well those just three things work and can work. And I love in storage, a little goes a long way. Like all of a sudden you're reaching out to people, you're getting a hold of them, you're taking it seriously. They feel that.
Yeah.
They see you investing in the property. They feel that. That makes people a lot more comfortable when you're raising rents, right? And cleaning up. And two, I think about this a lot and tell people, delinquencies and people that are in there that aren't paying, it's not just about you and your bottom line, it's about the other tenants. And I actually had a conversation with the tenant about this once, because they're like, this isn't fair, because we're like, no, if you don't pay the late fees, and I'm like, not fair. What about all the people that are paying?
Yeah.
What about the people that are paying on time, that are, doing the right things and everything? In a facility, you get a bad base, it changes the quality, right? You can get it, the people coming in and they're doing weird stuff.
Yeah.
And so like that security, that makes the rest of the tenants, they're going, okay, this place is under control, and that attracts a different type of tenant that you're looking for.
It does. And even things like landscaping, it just shows people that that person cares about their property. Yeah. Because the landscaping wasn't done very well.
Even in rural places, it really does make a difference. And it's one of those things that I think a lot of people in real estate overlook. Like you said, it's a business.
Just cut the grass.
Cut the grass.
Yeah.
Like, answer the phones, be proactive, right? And I understand it coming from other real estate where it's longer leases and everything else. They're like, it's kind of hands off, but to the customers, it's not, right?
Yeah.
And so you guys are doing all the right things, and you jumped in the water. Yeah. You went head first.
We did.
And it's paid off, obviously. So walk me through the one you just got, because now you got one under your management, which is different, right? Now you're looking at it kind of differently, saying, we're going to step in. That could probably changes how you look at when you're talking fees, everything else. So how'd you find that deal? Lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. They're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. We have them help us underwrite deals for our students and others. They are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it gonna look like? That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class. It's more than a bank. It's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand.
It was listed deal.
Yeah.
Awesome.
Like on Crexy is basically the,
Yeah.
or a broker email. Yeah. We don't really do off-market
Yeah.
marketing
Yeah.
at this point. So yeah.
But it was in that same geographic area?
Yeah, a little bit closer to the main city of Atlanta. So it's basically right outside suburb of Atlanta. Yeah.
Awesome.
So that's one thing we liked about it. It was closer in. It was kind of in our price point.
And it was a diverse property. It has two retail spaces and a commercial house on the property.
Okay.
Yeah, so it's
Yeah,
a little bit diversification. So those two leases were in place, so
Yep.
we knew we'd have that coming in.
Yes.
Because the occupancy is pretty low on that right now.
Yeah.
And so that we have some buffer there with that.
Nice. So you bought it, you got that set income, but then you have that opportunity that you guys are going to improve upon and build that up. Is that one of the reasons why you liked it, why you bought it? Was you thought there was room to do
There's
something?
definitely a value add there from the revenue, getting I like to call it the tenant improvement program, where you're getting better tenants and
Yes. I
raising
love
rates.
that. You're exactly right. Tenant improvement plan. Yes.
Yeah.
When you bought it, though, because you're like, okay, we're going to do this. How do you, when you were underwriting it, when you're looking at it, going, what timeframes do you put on there to either fill up, to stabilize? How'd you look at that in the underwriting part?
We try to underwrite ones that cash flow from day one, even with the current in place rents.
Yeah.
We don't have the resources to really cover
Losses.
losses for a long time. So they need to at least pay the bills from day one.
Yep.
So, and I like to add a little bit. I'm very conservative in my underwriting. So if I see an OM, I'm going to really, if they're projecting like 5% rent increases, I'll probably drop that to 1 or something.
Yeah. Yep.
So
We're the
we didn't
same
really
way.
have a time frame. If it happens in 6 months, awesome. If it takes a couple years, that'd be great too. But
And that's the best way to do it. You're not trying to rush and make something an opportunity that's not.
yeah,
You're waiting for the right deal, but then too, you're ready. Because then when it comes, you're ready to pounce on it. Now, when the asset you just bought, were the people that were running it or the company or whatever was going on, were they actively engaged in the management? Were they marketing? Or was this more of a laissez kind of?
I think they started down that path, and then
Yeah.
I think they just changed their mind. They just got burnt out. They just didn't feel like doing it. They wanted to move back north. So they were like, yeah, we just need to get rid of this.
We're ready to move on.
We're just ready to move on. Yeah. So that one. And they didn't do any tenant protection at all.
None.
So that was a great opportunity
Yes.
there.
So you had multiple lines where you could improve that revenue.
Yeah.
Walk me through that operation side. When you have these vacancies, because you filled up now multiple facilities, which you did the expansion, which is my favorite one. You get it, because that outside the cost to build, it's all profit, and you already have the cover, the safe underwriting. You got that income coming in. Love expansions. So, what was your strategy in filling up these assets? Was it just you were utilizing your already lists that you had? Like, how'd you go about it?
Well, for the other ones, our property manager was mostly working on filling that up. But we've worked really hard on Google, like the Google reviews. We give tenants like $10 off their rent if they'll put in a review for us.
Yes,
and we try
that's
to
good.
only pick the right tenants to do that.
Yep.
And so so we definitely noticed more hits to the website from doing that.
Yeah. That makes a
improving-
huge difference.
Yes, yeah, we've done, and then this new one is part of that same website, so it can kind of carry with that some, but definitely even things like signage, like we're putting in clear signage. The ones, the units that are vacant, we're making some improvements to them. Like they don't have foot handles, and they don't, things like that. So we're just making them better, so that when people do rent them, they're just better units to rent. But I think mostly just the internet and signage.
the basic kind of like the free stuff, like the Google Business Profile gets, especially for our other ones where the competition's a little bit less. Now we're, rather than at the bottom of the list, now we're near the top. Just by doing that.
Yeah.
We will probably do some online marketing for the one we just bought, just because there's a lot more competition.
Yep.
But we'll have to see how that works.
But it's on a very busy road too.
Yeah.
So
It is?
Yeah, that's why the signage
That's
is
why the
huge.
sign is.
They had this
is
old
huge.
crappy sign.
Yeah.
I think people really underestimate the organic nature of Google reviews, having good Google listings, making sure that that connects with how the facility actually looks, right? And that you have an address and a phone when they answer it.
Yeah.
When you're in markets that don't have good, I don't want to say good competition, but yeah, not good competition. They're not doing a lot of the online and not even big stuff, but maintenance and making sure that your online presence is good, like cutting the grass, right? It's the same thing, right?
Yeah.
That is such a separation and a competitive advantage. I talk about a facility that I had the worst location. It was on a land lease. The buildings were old. To say it was a worse location, you had to drive through the whole city, go up by the airport to get to it. All the other facilities were new and down in town. Highest occupancy and highest rates. The reason being is we were online, we had good Google reviews, and they weren't. And so we were a worse facility and by far the worst location of all the facilities. Highest rates, highest occupancy, highest demand, because everybody, when they went to find a facility, it was us.
Yeah.
And it was online. So it's like you can skew that supply demand metrics, right? And when you're in a market where competitors aren't doing it, online marketing, okay, great, but it's free. You don't even do that stuff, right? Now you get into the big markets with competitors that are doing that stuff, then obviously you got to work a lot harder on the online ads and everything. But that is it is probably the smallest things you can do that have the greatest impact, and they're free.
Yeah.
Now, that fill-up facility, I wanted to go back to the expansion facility. Could you walk me through the numbers? You bought it, and then you build onto it. What did that look like? How much did that expansion cost you guys?
So we bought the property, I want to say it was $660, maybe a little bit more, and it was about 120 units.
Okay.
Then we doubled the size, so we basically added another 110. I think that cost us a little over $550.
Yeah.
We were trying to scramble through the numbers.
Yeah.
And then we basically refied the loan and got new financing at that time. So we got like an SBA. What's the one that has two loans? That's the 504. I think.
Yeah. 504.
I always get confused.
Yep.
So and basically that was no money down. We basically refinanced the expansion that way. And as right now, it's a great loan.
Yeah.
So that
you're locked into a good
doing
loan, no money down. And it even with the loan in place, right? You filled up. What did that do to the value?
Just simply, it would double the value because we doubled the number of units. But now that we're increasing, the NOI, now it's probably 2 or 3 times.
Yeah, that NOI get a pretty good boost for that fill up.
Oh yeah.
Did it cover it when the expansion did the existing?
We weren't putting money in.
Yeah, we never put money in,
Yeah,
so we may have
so
been
we
cash
must
flow
have been-
even for a couple months, and then
Talk about the best risk to reward.
Yeah.
Right? Like, I love asymmetrical bets, right? Where the downside risk is limited, but the upside is huge. As opposed to if you just do a straight development, well, there's a lot of risk there. You don't have anything to go back on. So if you don't fill up, all the mass expensive. But you were able to double the property and basically fill no risk at all because it didn't change. Now your profit may have gone down, but you got the profit to go down to cover and then double it, which has an exaggerated effect on the profit because the expenses, everything's already paid.
Yeah.
That is a great financial move, obviously. And it's one that is really, I don't want to say overlooked, but I think people allocate more risk and are a little more nervous than understanding the upside compared to it.
Yeah.
Have you guys thought about developing?
Yeah, definitely. We've, like I said, we live in Arizona, and right now Arizona, as you know, Arizona is all about development. There's bare dirt everywhere, and it's not a big deal. But we're looking a little bit farther north, between Phoenix and Sedona. There's some. There's one that's a really interesting project we're looking at. Half of it's already built, but then there's a development right next to it. We want to develop that.
Part of it's RV storage, and then the other part is ready to be self-storage. Like the metal's already delivered and everything. The builder's just, looking for a buyer.
Yeah.
So we're meeting with them.
Obviously in trouble trying to
get out. Oh yeah, because we looked at it. We looked at it a year ago and thought it was a good deal, and now it's like
half
way
the price.
low. And we're like, oh, that's a really good deal now. And now the RV parking storage is for sale as well. So we can take advantage of putting them both together and having one, there's an office on site that could be for both.
Yeah.
So we're excited about that one for sure.
We're at that point in the cycle where these assets, because that's a lot of what we're doing right now, right? We're buying deals that were developed. They didn't ever intend on owning them. At the time, the world was very different when they started not, and now they're walking away. They're like, I don't want to own this. I don't want to run this. That was never my plan. I don't know what to do with it. And now I got problems with the bank. I either can't complete, I can't finish it. And so they're walking away at huge discounts.
Yeah.
And it is a situation where a lot of people, whether it's investors and banks, they only want to touch anything that has cash flow and large margins. We just don't see this very often where you can pick up deals like this in the marketplace that have such discounted amounts to where I'm like, I couldn't build it for that, right? At all. And especially when you're in locations like Arizona, right? Yeah. So good opportunities in that space. It can be obviously more risky, right? But at the same time, I start to go, well, how risky is it if we have demand and I'm already getting it at a basis that is less than what I can even buy it for. Yeah. So for me, I'm like, risk has gone down, a lot, and we're getting a lot of those opportunities. So I'm glad you're seeing them too. And now that you actually run it and you have experience like that probably makes you a lot more comfortable.
For sure.
Yeah, that's huge in underwriting when we talk to, because we work with kind of newcomers to storage, kind of gravitate toward us because I think our storage resonates. So one thing that we express to them that really makes underwriting a lot easier is now we know what the expenses are and like we have a good idea how it's going to run. You're not just saying, it's 30% expense ratio, or you take the broker's word for it.
Yeah.
So that allows us to, a lot of times we can cut certain expenses and we're comfortable with that lower price because we know exactly what it is. We know what this software is going to cost, and we know how much the call center is. And
it is a competitive advantage because you can get more aggressive. Because you're like, no, I know, it puts in confidence and everything else. What's your guys' background in? I mean, you talked about, getting into like residential and everything and then jumping into storage, but did you guys have real estate backgrounds? I mean, outside that, or was this side thing you guys were doing while you were working, or, how's that look?
I think like everybody, we read Rich Dad, Poor Dad, and we're like, we got to do this. And we're like young, and we're like, we don't have any money. And so we actually tried our hand at restaurants. So we owned 2 little delis and decided that was not the business for us. And then in 2010, it was right after the crash, and he's like, we really got to do this Rich Dad, Poor Dad thing, and we just need to buy real estate. And so that's kind of, it was like pulling the trigger on Rich Dad, Poor Dad.
Yep. And when you see your 401k, because we both had corporate jobs, when it gets cut in half, and you're like, okay.
You're like, that's not a good retirement.
And you had no control whatsoever.
I think a lot of people experience that. And it's interesting to me how after 2008, and as it was even for me, that feeling of that lack of control with everything. You watch the stock market just crash, you watch things go on, and it actually, the fear of it is good because it pushes you in the mode of, I've got to do something. Yeah. I can't just hope and things will turn out. And I think we get a lot of times, and lots of generations, they get in this idea that it should just happen, right? It should just be good. But then when it's not, it's different when it's not after it has been, because it's like a wake-up call. And you're like, okay, I can't depend on this. And that's scary, right? That's scary. It was for me. I worked a sales job. So we have kids, which is our 3rd kid, right? And I'm like, I'm running on a treadmill because, my clients leave. Some in 2008, they were all going out of business. So my income was going up and down. And, just like a normal W-2 job, I get fired and all of a sudden I'm like, lost 30% of my income. And I'm really grateful for maybe that anxiety or fear because that actually put me into not a mindset of like where fear may just shut you down, but instead it was no, there's more to do. I can do more. I need to do more. And that was that kind of Kickstarter to go, I got to rethink this.
Yeah.
I got to be in control of this. And a lot of people, that scare, that wake up call has really changed their lives, which you wouldn't think that wealth and all the growth and everything that you've had and that abundance that you've had would come from such a negative but I'm like, it actually does a lot.
Yeah.
It gets you moving, and it opens up your eyes. That's a story I hear a lot, including obviously with myself.
Yeah.
And I understand it. It's I think it changed the way the world thinks about wealth completely.
It gets you out of your comfort zone too.
Oh,
It's like
yeah.
you're just coasting along because things are going great, and then like, oh, okay.
Yeah. And change happens when you're not comfortable. So you guys had corporate jobs. You're trying to make it happen. Obviously, 2010, doing a good job on that. Now walk me through, you had managers. Now you jumped in and self-managed. You're doing great. You upped your income. You now created more wealth. You're looking at more deals. What is your plan? Are you wanting to keep self-managing them? Are you wanting to add more? Like, where are you guys going?
Definitely want to grow. Definitely want to add more. We've purchased all 4 of those on our own. So that we own them completely, but now we're looking to partner so we can do bigger deals.
Yes.
So that's kind of, we're like, well, let's take our expertise that we've learned, the management part of it, and get a bigger deal, pull the numbers together. He loves to do the numbers, and then we have the operational expertise, and we have investors who are interested in investing with us who don't want to be necessarily hands-on, but they want to be in a joint venture type of a structure where they can contribute. So, which we feel more comfortable with too, just being more of a partnership with people. And so that's kind of where our next step is to definitely have skin in the game, but have other people come in with the main load.
I love it. It's a natural evolution. Like you guys, we used our own money till we got to a point, and we took the losses and the burdens and those opportunity to fail, and just that risk of not knowing when you're doing it yourself, right? And then that made us more comfortable for where we could open it up to other partners, because now we know, and no, we're good. And so now you guys can come along and join us. It's a lot easier doing it that way than obviously if you have to get investors right out of the gate and you don't know. Now, not that that's bad, that's how most people actually have to do it, right? So you guys were in a good position to where you're like, okay, we've had all these years of spending and like investing and saving up, and now you can really expand. It's interesting to see that evolution too, right? And how it works, even from you guys, third-party manage, you single-family homes, and then commercial, third-party managed, then expanding. We're going to take over the management. We can now improve operations, creating more wealth. You're like, this is great. Buying another one. Now you're even looking at like more development, distress stuff you can get in. That's a fast progression over the last few years, guys. Like, that's awesome.
I think a couple years ago we read was the 10X book.
That
was our next big influence that we had.
Yeah,
and then
that's true.
Took us a little bit to get going, but
and it definitely, when you're using other people's money, you're just so much more cautious, and you'd hate to let anybody down, or it's one thing if it's yours. And so we've been really cautious on that, and now we feel like, okay, we can do this, and we're ready, and so we're excited about that phase.
I love it. Well, where can people actually find you guys or reach out to you guys and get to know? They want to talk to you, maybe learn from you, or understand what you guys are doing. Where can we send people?
So juniperinvestors.com.
Juniperinvestors.com. We'll put that in the show notes.
And then Jyoti's on SSI community, right?
Yes, on the self-storage income community.
Wonderful.
You can find me there.
Awesome. Guys, I'm really excited for you. I knew when you guys took over your facilities and started managing, and it was really cool to see. We've had, you've probably obviously talked to some people in the community, not alone. We've had multiple people do that. And it's amazing how empowering I think that was for them when they're like, wow, we can do this and change this and actually grow that, and the confidence that brings. So I'm excited to see what you guys build out of it. I'm excited to watch you as you grow, take on more, because you guys are now at a point where you feel comfortable too. So thanks for coming on. Thanks for sharing your journey and what you guys have learned. It's exciting.
Thanks for having us. It was great.